Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about the pattern day trade rule, or PDT as a lot of people know it. Now, pattern day trade rule is something that was put in place, which I find personally to be more of a hindrance than anything else. A lot of times we'll do small account challenges where we take a small account and try to grow it as much as we can, and it really comes into just being a pain to deal with. So a lot of it really just has to be understanding what the PDT is so that we can work with it so that it is less of a hindrance, or at least as minimal of a problem as possible. So when we're talking about the pattern day trade rule, essentially what it is, by definition from Investopedia, it is a pattern day trade is known as a day trader who purchases and sells the same security on the same day in a margin account. Pattern day traders must also have more than 6% of those trades occur in the same margin account for the same period to be considered separate from a standard day trader. These securities can include stocks, stock options, short sales, as long as they're occurring on the same day. Now, the amount of trades that you can have, generally speaking, most places will limit you to 3. I believe the actual SEC definition is 4 within 5 trading days, but most just stick with 3. And what that means is I buy, since Facebook is open, I sell Facebook short and I buy it back 10 minutes later. That is one PDT. That was a purchase and an exit on the same day, on the same security, right? That is one pattern day trade. That would mean that I have used 1 of my 3. So if I do it again, now I only have 1 left. If I do it again, now I have 0 left. And you have to wait for a full cycle, a full week, excluding the weekend, to come back around. So because today is Monday, and at the time of recording this video, if I were to place a trade right now on Monday, today, I would have to wait until next week Monday until that PDT drops off. Now, that is a little bit of a problem, because essentially what you have to deal with is you have to really start to figure out, okay, well, I'm going to trade 1 trade here, and then you have to be super selective. Now, there are a couple ways around this, okay? You'll notice some of the very specific wording in what a pattern day trader is. It's done in a margin account. That means that if you were to trade a cash account, you wouldn't have to deal with the PDT as much. Now, you do still have some setbacks if you're trading a cash account, and that is the settlement time. Now, the settlement time on a cash account is, well, we can pull that up too. Hang on one second here. There we go. So by definition, again, I like giving the pure definition, and then we can break into it. A cash account trading rule: trades placed in a cash account require 2 business days for the funds to fully settle. So that means that the money I made or lost on that Facebook theoretical short we were talking about, that money won't be back in my account again for another 2 days. Now, the cool thing you can do with this is you can split your account up in thirds, okay? So if you're trading a cash account and you just don't want to deal with a PDT, it's pretty straightforward. All you have to do is say, okay, well, I'm trading a small account of $2,000 and I want to split this up. So I have a $2,000 account and I need to cut this into thirds. Now, 2,000 doesn't really divide easily, so let's just do 3,000 to make life simpler. That means that on day 1, I can trade $1,000 worth. On day 2, I can trade $1,000 worth. On day 3, I can trade $1,000 worth, right? So you have a 3K account. You allocate 1K for day 1, 1K for day 2, and 1K for day 3. And the reason you would do this is because it's a 2-day settlement period. So the trade that you took on day 1 will settle on day 3. So it's this ever-rolling kind of period where the settlement amount won't come back to your account until day 3. But if you split your account up into thirds, you basically don't ever have to worry about PDT. You're always using the same amount. Now, $1,000 trading stocks, you're probably going to have a pretty hard time, but you can trade options that way and not have to worry about the PDT because you're splitting it up into thirds, right? Now, again, this is on a cash account. This doesn't work on a margin account. This is a cash account only because of the 2-day settlement period. So this is one way to kind of get around the PDT. You still have to deal with it in a way because you have to split up your account into thirds and trade smaller size than you might be used to. But it's a way to get around it so you can basically take as many trades as you want as long as it fits within the allotted amount of money that you have set aside for it. Another way to do it is to open multiple brokerage accounts, right? So if you want to trade, let's just use options and stocks, right? So you're trading options and stocks and you want to allocate $10,000 to it. 10K to options, stocks. But you're doing it in a way that you're under $25,000, which means you would have to deal with the pattern day trade rule. So because your account is under $25,000, we have to deal with PDT. And what we could do is we could separate this amount of money into a bunch of different brokerage accounts. So we could take this $10,000 and we could move, let's say, I don't know, $2,000 over to Robinhood. So you've got, I'll just do RH. So you've got a $2,000 account over at Robinhood, and you have another $2,000 account over at Thinkorswim, and you have another $2,000 account at E-Trade. You get the idea, right? So you have another, and you're basically just splitting up the amount of money that you have to all these different brokerages, because PDTs are not per person, it is per account. And that means that if I place three day trades on Robinhood, I have to wait the full 5-day period until that drops off and I can trade them again. But guess what? I still have 0 PDTs on TOS. I still have 0 PDTs on E-Trade and all the other ones. So by splitting them up, I basically just shift around, right? I can take 3 trades here. I can take 3 trades there. I can take 3 trades there, 3 trades there. And preferably, you'd want to have maybe 5 accounts. So that way you can take 3 trades there. And by the time this one comes around, you're back over to this one, right? And you just keep cycling around and keep going through them. So there are ways to get around PDT, but generally speaking, PDT is a little bit of a pain. You know, it's one of those things that, you know, if you're outside of the U.S., you don't have to deal with. Congratulations, you know. For us in the U.S. that are working with smaller accounts or maybe doing a small account challenge or whatever the case happens to be, if you're under $25,000, you have to deal with PDT. And we need to know what it is and ways to maybe even kind of, you're not really circumventing it, but kind of circumventing them so you can continue to trade and not have to deal with it. Now, there is also a third option, which is opening offshore brokerage accounts. Obviously, that's not recommended. They're offshore, meaning that you're not secured, so that if they were to dissolve, your money's gone. And the SEC is not going to do anything about it because, well, you opened it up out of the U.S. So not recommended, but there is a third option that, you know, a lot of traders do use, going with brokerages that are outside of the U.S., outside of U.S. jurisdiction, which means that you don't have to deal with PDT. As well as introducing brokers, meaning that you're more of a prop firm. You're buying into the prop firm to trade their money. So even though you're taking multiple trades, it's not your money. So I don't know. Some of that shady stuff I don't necessarily recommend, but there are some good ways to get around it without putting yourself at a huge amount of risk, like a brokerage account in the Cayman Islands disappearing and all of your money being gone. So that's the PDT rule. Again, just a general wrap up. Accounts under $25,000, you can take 3 trading days in a 5-day period in a margin account. If you want to get around that a little bit, you can utilize a cash account by splitting your account up into thirds, so that way you can trade 1, trade 2, and by the time the 3rd day comes around, the settlement period of 2 days has come off, and it gives you back the money that you made or lost from the previous one, and you can just keep on going. Then, of course, another way is to open up a bunch of different accounts at smaller values, so you can trade them all, preferably not simultaneously, but focus on this account for 3 trades, this account for 3 trades, etc., and that way you can kind of get around it that way. And then there is the other option, which is opening offshore accounts, which is not recommended. So that's going to do it. Hopefully you learned something. If you're relatively new to trading stocks or it's something that you might be interested in, but you're not quite sure, these are things that you need to know before you jump in so that you're not taken off guard, taken by surprise. Because if you do hit PDT and you don't talk to your broker about it, your account's locked for 90 days. And I don't know about you, but I don't like my money being locked away with me not being able to do anything for 90 days. Not a fan of that. So make sure you understand the full aspect of PDT so you don't get caught on the wrong end of things. You don't want that to happen. But that's going to do it for this one. Hopefully you learned something. Hopefully you found it useful, interesting, and maybe something that is an eye-opener if you were looking to get into stocks that maybe you didn't know. Aside from that, that's going to do it. As always, I hope you had a phenomenal trading day today. I hope you have a fantastic trading day tomorrow. And until the next one, we'll see you all then. Thanks.